Hello. In the previous video, we discussed context, which is the most important and powerful concept in technical analysis. Technical analysis without understanding context is essentially meaningless and can even reduce your chances of success to less than flipping a coin. Since this topic is very important to me, today we will also focus on context and present it in a more advanced and comprehensive way. If you enjoy my educational content, please support me and subscribe to my channel. Thank you. Now, let's look at the chart. Pay close attention. We are observing a bullish downtrend. Why do we see this chart as bearish? Because the overall direction is downward, and every time a high is formed, the subsequent low is lower, and the next high does not reach the previous high. This is the definition of a downtrend. But why am I explaining this? Because this concept, while simple, is deep and professional. Yet many overlook it and search for complex analytical methods, only to end up with nothing. On this chart, as long as we see lower highs and lower lows, do not even consider taking long positions. A very important point I want you to focus on is this. Do not look at the candles individually or focus on minor fluctuations. You need to view the chart as a whole and identify major swings to trade in the direction of the trend. On this chart, I will mark the major swings for you to better understand my point. As long as you see lower lows and lower highs, prepare to sell. This is a very professional, simple, and executable approach in live market conditions. Just look at the highs and lows to understand the context. Now, let's look at the chart from the perspective of a beginner trader. This trader thinks, the price has dropped significantly, so it's a good time to buy here. But what happens? Stop loss. The price drops further, and the trader thinks, if I enter here, there's a 100% chance of an upward move. And again, stop loss. Now, frustrated, the trader recklessly enters long positions at every minor correction, resulting in a significant and irreversible loss to their trading account. The main reason for this mistake is trading against the context. Professional traders identify highs and lows and use this professional perspective to determine the likely future direction. Now look at the next example. What is the context in this chart? To determine this, first identify the major highs and lows. In this chart, the highs and lows are as follows. What we see is higher highs and higher lows, so our context is bullish. It's that simple. Now tell me, is this move the start of a downtrend? And should we enter a short position? Or is it just a correction in an uptrend? We've clearly identified that the context is bullish, and the overall direction is upward. Therefore, the buyers have more power, and this is just a correction in the uptrend, presenting a good opportunity to enter a long position. However, for those who are new to the market, please don't get too excited. You need to practice extensively and master psychology and risk management before starting to trade. I will cover psychology and risk management in detail in the future, but for now, start practicing patience. Patience is a profound concept in trading and requires a high level of self-control. Now, let's look at the next example. Naturally, this one will be more challenging. I'm not here to make trading seem easy. I'm here to reveal the reality. In this example, identifying the highs and lows is difficult because they are nested within each other, creating a visually unappealing structure. Whenever you see such patterns, know that you are likely in a trading range, where the price is neither bullish nor bearish, but moving sideways. The best approach here is to buy at support and sell at resistance. But for more advanced traders and those who crave deeper insights, there's more to this chart. Even within this trading range, we can see lower highs and lower lows forming. This indicates that within the range, a nice downtrend is developing. Once this downtrend reaches the bottom of the trading range, it may end, and an uptrend could begin, pushing the price back to the top of the range. This is an important insight for more experienced traders. Beginners should stick to the basic trading range perspective until they become more advanced. Finally, let's look at the last example. We see a bullish spike, followed by the start of a channel. This channel forms higher highs and higher lows, so each of these points presents a buying opportunity. However, the key point here is that the previous low is broken, creating confusion. Does the bullish spike have more power, or is the downtrend stronger? If you feel confused in such situations, know that it's completely normal. This confusion itself is a sign that you're entering a trading range. If even a professional trader feels confused, everyone else is likely in the same boat. Therefore, we won't see the start of a downtrend, but rather enter a phase of indecision, which is the trading range. I won't elaborate further. Please practice this concept daily. And if you have any questions, feel free to ask me in the comments. I wish you success.